In 2007, while millions of Americans believed the economy was stronger than ever, one billionaire quietly prepared for disaster. Banks were celebrating record profits, Wall Street was unstoppable, and the housing market looked invincible. But behind the scenes, one investor believed the entire system was built on a lie. His name was John Paulson, and the trade he placed would eventually make him billions of dollars. At the time, America was obsessed with real estate. People bought houses believing prices would continue rising forever. Banks approved loans at incredible speed. Even people with low income and terrible credit could suddenly borrow massive amounts of money. Because on Wall Street, risk no longer mattered. The system had become addicted to growth. Banks bundled risky mortgages into investment products and sold them across the world. Investors trusted these products because rating agencies labeled many of them as safe. But hidden underneath the surface, the entire structure was becoming unstable. And most people never noticed, but John Paulson did. Unlike many investors chasing short-term profits, Paulson studied financial risk carefully. At first, he wasn't famous. He wasn't considered a Wall Street superstar. In fact, many people underestimated him. But Paulson had one important advantage. He understood human behavior, and he believed financial bubbles always follow the same pattern: excitement, greed, overconfidence, then collapse. As he studied the housing market, he noticed something disturbing. Mortgage lenders were giving loans to people who could barely afford monthly payments. Some borrowers had no stable jobs, others had enormous debt, and many mortgages carried low introductory payments that would suddenly increase later. It looked profitable in the beginning, but eventually, millions of homeowners would struggle to pay. And if enough people defaulted, the entire housing market could collapse. Paulson realized something terrifying. The financial system was filled with toxic debt disguised as safe investments. And if housing prices stopped rising, panic would spread everywhere. So quietly, he made one of the boldest decisions in financial history. He began betting against the housing market. Not publicly, not dramatically, quietly, patiently, using complex financial contracts called credit default swaps. Paulson essentially predicted mortgage-backed securities would fail. If the market continued rising, he could lose enormous amounts of money. But if the system collapsed, he would make billions. At first, almost nobody believed him. Banks continued making money. Housing prices remained high. Wall Street ignored warning signs, and many investors thought the housing boom would last forever. But Paulson stayed focused because he understood something dangerous about financial markets. When everyone believes risk has disappeared, risk is usually at its highest. Months passed, then cracks slowly began appearing. Homeowners started missing payments, mortgage defaults increased, housing prices weakened, and suddenly panic spread through financial markets. The same investment products once considered safe became toxic. Banks suffered catastrophic losses. Major financial institutions collapsed, stock markets crashed, and fear consumed Wall Street. The global financial crisis had begun, but while billions disappeared across the financial system, John Paulson's prediction became reality. His hedge fund reportedly earned billions of dollars, one of the largest fortunes ever made from a single market event. Almost overnight, he became one of the most famous investors in the world. But the story was never just about money. It was about understanding how financial bubbles truly work. Because bubbles are built on emotion, optimism, greed, and the belief that prices can only continue rising. During bubbles, people stop questioning risk. Success creates overconfidence, and overconfidence creates danger. John Paulson understood this deeply. He understood that markets are driven by psychology as much as economics. And sometimes, the biggest opportunities appear during moments of extreme blindness. Even today, The 2008 housing collapse remains one of the most important financial events in modern history. Millions lost homes, entire companies disappeared, and economies around the world suffered enormous damage. But the crash also exposed something powerful. Markets reward independent thinking, not crowd behavior. Because while most investors followed excitement, a small number of people quietly studied reality. And when the system finally broke apart, they were prepared. John Paulson did not predict the crash because he was lucky. He predicted it because he was willing to question what everyone else blindly accepted. And in finance, that ability can become incredibly valuable. The greatest financial bubbles are built on the belief that this time is different. But eventually, reality always returns.